Welcome to the Wealth Wisdom Podcast. I'm your host, John Lawson, Senior Wealth Advisor at Assante Capital Management and co-founder of Sana Family Office. We're always looking for unique ways to educate our client families and be introduced to new clients. At Sana Family Office, we help business owners and affluent families navigate the complexities of wealth through a variety of wealth management and family enterprise oversight services. Today on the Wealth Wisdom Podcast, I thought I would introduce everyone to our investment counselor on the team, Sean Rosas. Sean has a great variety in his past experience and brings a depth of knowledge and expertise to our clients, which I thought we'd share a little of today. So welcome, Sean. Why don't we start by you giving us an overview of your past experience in this industry?
Great, thanks, John. So I've spent the good part of 2 decades prior to Assante working in capital markets in the US, Canada, and the UK. So in that period, spent a lot of time analyzing companies from a fundamental point of view, managing risk, and also distributing product to investors. And most recently, worked at a family office where spent a lot of time thinking about the more personal side of the equation, which is some of the tax considerations, estate planning, and just the risk return components to a portfolio. And joined Assante about 1.5 years ago, and love the stocks and bonds and private equity world. So really excited to be in this role.
Awesome. Thanks for that. And so I mentioned off the top, Sean is our investment counselor. And what that means for our clients is he takes care of our private client at the private client service level. Sean is the one who constructs, oversees, and advises our clients on their client's portfolio. For those of you who don't know, our private client service offering can start with portfolios as low as 1 million if it's a growing asset and if the client has complexity that our wealth management and family office services can add value to. The more appropriate level of investment is about 5 million plus. Sean, I thought we'd also talk about what's the focus of our client meetings this fall. In one word, I would categorize it as opportunity, but tell me what you've been talking about, and maybe I'll prompt it a little bit because you've been talking a lot about seeing big opportunity in bonds.
Absolutely, and certainly we've all been bludgeoned by some fairly gloomy media. Certainly the economic backdrop doesn't look promising in the near term, but the silver lining is we are seeing great opportunities in the fixed income space after a fairly horrible year. Yield is back. Ideas and investments that were unthinkable a year ago in terms of return are now quite interesting, and I'm thinking of certain strategies that we have that are close to 10%, which in 2020 or 2021 would have meant taking on a preposterous amount of risk. So while the equity markets and also the bond markets are materially down this year, we're kind of putting that into the rearview mirror a little bit and looking forward, and we're quite excited by some of the investments we see coming down the track, both in the short and medium term. The income space we can talk a little bit more about, but certainly also equities. We're seeing dividend yields in 5-6%. So investors are paid to wait and to kind of manage through some of the economic turbulent waters that we're experiencing.
Yeah, great. And so just maybe give me more of a specific idea. So because I think you're right, we've been in such a low interest environment lately. When somebody talks about those types of returns, they think, oh, you must be taking a lot of risk. So what's an example of an income opportunity?
Well, starting at the what we'd consider to be risk-free, which is daily interest savings rate. So we have a daily liquidity fund which is yielding 4.2%. And with the Bank of Canada potentially another hike on the table on December 7th, that could be anywhere from 4.5, 4.75%. So that's cash. So that's our starting point in terms of the investment equation. And if we move a little bit further out, we see investment grade bonds earning 6-7%. You look at the Canadian banks, fairly safe hands that we see product in 7-8%. And then if you go a little bit further out the credit spectrum, there are investments with a 2 handle, which is to say 10% plus. We're a little cautious on those at the moment, but certainly we're intrigued by where some of these yields are, and we keep in the back of our mind where inflation is, and we want investors to be moving forward net of inflation. So we want to be investing funds higher than the inflation rate so that investors are generating a positive real return.
Absolutely. So let's switch gears a little bit, because what we've been talking a lot about, and to be fair, it's been much longer than just this fall. But again, bright spot in our portfolios has been private equity. Why don't you give just a quick explanation? What is private equity, and why is that playing such a big part in our portfolios?
Private equity, in essence, is looking at companies that are not listed on an exchange. So the NASDAQ, the Dow, the S&P, and so forth. If you think about a lot of the household names, Facebook, Tesla, a lot of these companies are, and in fact, most started in the private equity world. So it's just a different part in terms of the incubation period of a company. It's more on the early stage, and really it's just an investment strategy that invests in private companies, typically in a higher growth phase than what we're seeing in the public markets. And we also like the space in that it's slightly different. Private equity, the time horizon is 3, 5, 7 years, whereas we're seeing in the public markets, in a lot of cases, the ambition is to try and deliver returns for the next quarter and deliver news releases to create momentum for your stock. Whereas private equity is a slightly longer horizon, and we think that balances out portfolios quite nicely. The other dynamic which we like is the return, and for the strategies that we've selected in the private equity space, there's a slightly elevated return. The quid pro quo is that you're giving up a little bit of liquidity, but we structure portfolios that investors can, we can meet the liquidity needs, but also, park some of the funds into higher yielding strategies where the liquidity isn't needed, if that makes sense.
Yeah, no, absolutely. And I think part of what you were touching on there, but I'll just articulate it maybe a little bit more, is that one of the things that private equity gives us is it helps smooth out that volatility, because instead of focusing on an investment that is valued on a day-to-day basis with the emotion of whatever is going on that day, you've got a portfolio of private companies which is much more focused on that 7 to 10 year range, and it just naturally smooths it out. Does it go down at times? Yep, a little bit. But not near as much as the rest of the portfolio. It's a much better reflection of long-term value of underlying companies. So I'm going to pivot just only slightly from there, because the other area that we've been utilizing a lot is private infrastructure. So you can almost consider it a cousin of private equity. Do you want to expand on that a little bit, Sean?
Private equity is complemented quite nicely by private infrastructure, and infrastructure is a broad asset class, but we see it sitting as kind of a hybrid sector somewhere in between. the equity world and the fixed income bond world, in that it has very safe characteristics. If you think about airports, toll roads, electricity grids, these are big box assets that are heavily regulated by municipalities, local governments, and for that reason have an implicit government support. What we like about private infrastructure is that it gives our clients access to a sector that has not been previously available to individuals. And certainly pension funds and university endowments have been, longstanding investors in this space, and are continue to increase allocations. So if we think of, Canadian Pension Plan, which is our retirement portfolios here in Canada, they invest quite heavily in infrastructure, and we're providing access, to our clients. And one thing we like about infrastructure is that unlike fixed income bonds, as interest rates go up, there isn't capital destruction in infrastructure assets. A lot of the returns are linked to inflation. So if you think about a toll road, these are regulated, and the returns increase. Airports, for example, have an airport improvement tax that they can take. So we like it as to John's point earlier, something that smooths out returns in an investment portfolio, but also provides elevated yields. And certainly in this year, we saw that there was a lot of correlation between both equity and fixed income markets in terms of everything sold off at once, and there was no safe haven. It turns out that infrastructure provided some of that safe haven type dynamic in terms of not selling off to the same degree.
Yeah, absolutely. It's been a favorite inside the portfolio. So these three have been the focus for us when we're talking to clients, but that doesn't mean we're shunning publicly traded equities. What's your take on some type of recovery coming down the road for publicly traded equities?
Yeah, I think the base case is public equities will recover. I think the question is what's the time frame? Absolutely, public equities will remain a core component of our portfolios in the long run. We've seen, a tremendous track record of all indices, and so we continue to like the public markets. We find it very interesting right now from a stock selection point of view, doing homework. I think, looking at balance sheets, access to capital, strategies, business plans, relative value. These are all, I think, more important than ever. So, we're I would say glass half full on public equities. And as we talked about earlier, the timing could be very short term in terms of there being plenty of cash on the sidelines, or it could be, sometime mid to late next year. But we do see a bounce, and in the meantime, investors are compensated from a dividend point of view, but also we could look at other strategies in the income space. Yeah.
Absolutely. And so one of the things that we often talk about in meetings is that with our securities that we have inside the portfolio, our management teams that help put together the different pools that we use, they are constantly reviewing what investments we have inside, what kind of companies do we have inside there. And it's not because any of them have gone to zero or blown up. It's simply because it's the proper thing to do. It's the right thing to do. Markets have pulled back dramatically. Different companies have pulled back at different levels. And so we always need to relook at the scorecard and say, okay, this is a great company that we own in there right now, but is there better companies that we can position for moving forward that are in a better position to capitalize on the markets going forward? So that's one piece. The other piece that I'll just touch on very briefly We have to understand that there's a difference between the economy and markets. And markets are forward thinking and looking forward to see what's going to happen. So it takes a view at the future and makes decisions on that now. And one of the biggest trigger points that we see markets reacting to is interest rates. As it appears that we're starting to come closer and closer to the end of the interest rate hikes, Canada specifically, US probably a little longer because they're a little further behind the curve. But markets like that. And so then they're assessing what ramifications that has to the companies, the individual companies. And maybe this is a great time to be buying. Maybe we've just been bumping along the bottom for this last bit of October, November. You never know that for sure until you're 6 months, a year down the road and you're looking backwards. But that's how markets react. The economy, on the other hand, is playing catch up. It's reacting to the interest rate hikes that happened 6 months ago. And so the full impact of the interest rate hikes has not been absorbed into the economy yet. And that's why you hear about some pretty dire, Sean, you mentioned it in the beginning there, the news, some pretty dire news about next year being a really, really tough year. And what they're talking about is economically, they slow down. All these impacts of the interest rate hikes are going to have more and more of an impact. If you think, call it 6 months running behind, they're still raising interest rates now, but we're really economically at a position of absorbing the rates from 6 months ago. So you fast forward that, you turn the circle around, and we're probably going to see the worst of the economy in the later half of next year. But we very well could be seeing that at a time that the actual stock markets are going up. So more of a monologue that I wanted to create there, Sean, but anything that you wanted to add to that?
No, I think that's absolutely right. We saw with the U.S. inflation reading coming in a few weeks ago, 0.3 better than expected, and the Nasdaq rallied 8%. So that is there's a couple takeaways there. I think one, there's plenty of cash on the sidelines, waiting to go back into the markets. That creates a lot of opportunity potentially on both the income and the equity side. But it also, if you think about the public markets moving in these, pretty broad, like 5-8% moves are significant. And we don't value homes on a daily basis where the swing is 5 or 8%. And it speaks a little bit to the value of having some of our private equity or private infrastructure strategies, where those pools basically will smooth out the portfolio return, and the managers are focusing on just delivering long-term return, maximizing free cash flow without focusing too much on some of the noise that we're seeing on screens.
Yeah, absolutely. Well, that's fantastic. Sean, it's a pleasure having you on our team. And thanks for taking the time to give our listeners a peek inside the opportunities that we've been talking about with our clients.
Great. Thank you, John.
A big thank you again to Sean Rosas for being our guest today. Our next planned podcast will be a market update recapping what happened this year and what did we see in nope, let's redo that. A big thank you again to Sean Rosas for being our guest today. Our next planned podcast will be a market update, recapping what happened this year and what we see in store for 2023. Did I really just say 2023? Oh my goodness. These are always a favorite as we try and deliver a message in an informative manner and plain English, so not too difficult to understand. Looking forward to this, as they are always fun to do. Ultimately, our goal is to educate and engage you, our audience. If you have any topics you would like us to dive deeper into, please let us know. If you could take a moment to post a review, it would also be very much appreciated. And if you would like to access other videos, podcasts, or articles we have done, visit us at saunafamilyoffice.com. And for those of you who don't know the origin of the name Sauna Family Office, it stems from the meaning of Asante, which is Swahili for thank you. However, the most commonly spoken phrase in Swahili regarding Asante is Asante Sana, which means thank you very much. This name represents the gratitude towards all the families and business owners who have chosen our team as their trusted advisory council. Until next time, Asante Sana.
Hi, I'm Trevor Beggs from Sauna Family Office, and thanks for listening to John Lawson and the Wealth Wisdom Podcast. Here are the necessary disclosures. Assante Capital Management is a member of the Canadian Investor Protection Fund and Investment Industry Regulatory Organization of Canada. This material is provided for general information and is subject to change without notice. Every effort has been made to compile this material from reliable sources. However, no warranty can be made as to its accuracy or completeness. Before acting on any of the above, please make sure to see a professional advisor for individual financial advice based on your personal circumstances. The opinions expressed here are not necessarily those of Assante Capital Management. Thanks again for listening, and we'll catch you next time on the Wealth Wisdom Podcast.